Welcome, friends. Continuing our session on the paper of Advanced Financial Management, Paper 2, Final Level, ICAI Ashish Gupta welcomes you all. Student, in last class, we have started our topic of bond valuation and we have solved some questions also. In today's session, we shall continue the same. So assignment have been second assignment have been uploaded and some questions have been left over of the first assignment that we will continue. Then we shall move on to the assignment number 2. Okay, student. So with this, we start the session now. Let us start. Kusuma Singh, good morning. Good morning, beta. One second, students. Only 1 second, students. So I'm getting connected. Well, student, Salesh, good morning, beta. Shruti, good morning, beta. Viraj, good morning. Now, uh, you can see on your screen the questions that we have solved in earlier class. Okay, student, now I am quickly coming to the question number 7. Please read out the question quickly. The question says like that ABC Limited has following outstanding bonds. These are the two bonds. The duration is this. Variable changes in the Series X bond carrying a coupon of 8% and maturity period is 10%. And Series Y is carrying variable changes annually comparable to prevailing. So it means it is a floating rate bond. Okay, it is a floating rate bond. Initially, these were it would at a face value of rupees 10,000 with a yield to maturity 8%. Okay, assuming that after 2 years from the date of issue, interest comparable to bond is 10%, then what will be the price of the each bond? If after 2 additional years, the interest rate on comparable becomes 7%, the price of each bond. What conclusion you can draw from this one? Okay, so students, now I start solving this question. Now, students, so far as the first, I start with the first part. Very important. When this bond has been issued, the period was 10 years. However, years have been elapsed or it has been passed off. Then remaining period is left over is 8 years. Okay, so 8 years is the remaining period. So accordingly, we shall evaluate the debenture accordingly. First of all, for X, the coupon payment is 8%, and our debenture face value is 10,000. Accordingly, our coupon will be okay. The coupon payment will be rupees 800. So accordingly, present value we have to compute what should be the price of each bond. So to compute the value of each bond, we shall discount the same. आपकी आवाज topic कम आ रही है. Let me check. निसर्ग, मेरी आवाज क्या कम आ रही है क्या? बच्चे कह रहे हैं हाँ. अच्छा, अब एक मिनट रुकिए रुकिए रुकिए. अब देखिए अब आ रही है प्रॉपर. रुकिए 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 एडजस्ट. एक मिनट मैं दोबारा करता हूँ, इस बार हो सकता है दोबारा ठीक हो जाए. अभी देखिएगा. सेम ही आ रही है क्या? रुकिए रुकिए रुकिए. अब वही आ रही है आवाज वैसी है अभी भी क्या? 1 सेकेंड. ये स्क्रीन शेयरिंग में थोड़ा इसका परसेंटेज बढ़ा देना. बच्चे कह रहे हैं जूम कम आ रहा है. जूम द क्वेश्चन आ रहा है. देखना थोड़ा सा. ऐसे बच्चों को नजर. 1 सेकेंड. आवाज क्या कम आ रही है मेरी क्या यूट्यूब पे? हाँ 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 हाँ. अच्छा वो छोटी आ रही है. निसर्ग इसको एक मिनट मतलब कैसे इसको इंटर मतलब मेरी इमेज ज्यादा आ रही है. हाँ हाँ हाँ. अच्छा अच्छा. इसको ऐसे. एक मिनट रुक जा फिर अभी रुक जा, अभी हो जाएगा ठीक. ओके ओके नो प्रॉब्लम हो जाएगा अभी ठीक हो जाएगा. अब देखो अब हो गया ठीक. हाँ अब हो जाएगा. ठीक है हो जाएगा. अब आ गया ना? अब देखना ठीक है ना? ठीक है ठीक है ठीक है. आ गया. नहीं अब देखो अब आ जाएगा. मैंने चेंज करा है वो निसर्ग से बात हुआ है ठीक हो जाएगा. ठीक. देखो नहीं तो होल्ड करके मैंने कोई बात नहीं देखो. आई थिंक स्टूडेंट्स को ठीक नजर आने लग गया होगा. सर अभी भी. चलिए मैं अभी देखता हूँ, मुझे बताना है, ठीक है प्रॉब्लम। अगर कोई प्रॉब्लम आए फिर मुझे बताना, ठीक है, ओके, ठीक ठीक, ओके ओके। Okay, student, now let us start solving. Now 8 years has been remaining period. So accordingly, we compute the present value of the same. And for this, we use present value factor because our period is comparable bond. Since comparable bond, the yield is it is our 10%. So we shall use the same. Okay. So this factor will be 10% yield to maturity plus our principal repayment 10,000 into present value factor at the 10% rate of 10%. Okay. Please note here we are using annuity. Here we are using only one factor. Clear? Now we use the value comes around 4268, that is PV factor relating to your interest portion, and total it comes 8938. Clear, student? Now we come to the second part. It says it is a variable which changes comparable to the prevailing rate. Now here it is a prevailing rate is 10%. So accordingly, the coupon rate for the same bond will be 10%. Okay, Marshall, thank you. So now accordingly, we change the same. 1 second. Now bond value. Now we compute it for the bond value. Vary according to variable interest. Since prevailing rate of interest is 10%, we shall use the same as coupon payment. Okay. So accordingly, our face value is 10,000. Our interest is 10%. So rupees 1,000 will be paid. And accordingly, we shall compute the present value investment factor at the rate of 10% plus this. Accordingly, the amount comes Okay, student, if I am correct on and incorrect on any place, please let me know. Let me check and go. Okay, student. Now it says we come to the second part. It says for additional 2 years, or if after two additional 4 years, it means two more years have been lapsed. Accordingly, the period left over is 6 years. Okay, and yield is 7%. Okay, so bond X, we compute since it is carrying 8% coupon as we have done earlier. Okay, student. Now bond Y, as I told you, it will be rate of interest will be 7%. Coupon will be 7 PVIF AF. Okay, student. Now it says what conclusion you draw from the same. Is it from the same? So the conclusion is drawn if the price of bond series X moves inversely with the change in interest, whereas price of bond does not change. Please see here the price of bond is 9,000 approximate 10,000. Okay, and here also our price is somewhere around 10,000. So what does it indicate? If with a change in the interest rate, it is moves inversely because here now you see coupon rate is 8%. When we see 10,000 discounting there, okay, so our price of the bond was 8938. It is less than 10,000. Okay, when our coupon rate YTM is 7%, okay, it is greater than 10,000. So it moves inversely. Whereas here, since it is a floating rate, whatever be the prevailing rate of interest, it will be same. So it will move in tandem with the prevailing rate. Okay, student. Now with this, we come to next question, Pickering. Now, student, this is a question of amortizing bond. A PSU is proposing to sell 8%, 8 years bond of rupees 1,000 at 10% coupon per annum. The bond amount will be amortized equally over its life. It means 1 to 5 will be refunded each year. If an investor has a minimum requirement of 3%, it means it is a YTM. The what is the bond present value, or we can say what is the price of bond? What is the justified price of the bond? Okay. Now, student, let us start solving the same. Now, in the first part, first of all, we determine the interest. What will be the interest will be payable? Okay. First of all, since 10% interest is there, okay, because see the question, it says it is a 10% coupon. So for in the first year, on the initial amount of 1,000, we draw calculate the interest. Okay, principal amortize 1 to 5. Okay, so cash flow will be on. Now, students, please always remember we shall go by the cash flow. This is like as I told you, capital budgeting, bond valuation is kind of a capital budgeting decision. So mainly we are concerned with the cash flow. We shall concentrate. We shall concentrate on the cash flows. Mohammed, sir, what is the notes? Student, so far as the uploading of the solution is concerned, we encourage the student, please go through our lecture and prepare your own notes. All solutions are here. Okay, so it is better you practice the same with along with us. So prepare your with your own hands. So selling a YTA premium is less than selling at premium YTM is less than. Manisha, I could not get what exactly you want to say. Selling premium YTM is less than coupon rate. Selling YTM premium YTM is nothing. No, not a premium. Okay, student. Now, when we talk about this interest of the second year, see here, our bond was of 10,000. One second, student. Sorry, my mistake is interest is 100 rupees. My interest is 100 is a 125 to 25. Okay. Now here, when out of 1,000, we have repaid 127. So principal will be left over 875. On 875, when we will pay the interest of 10%, the amount of interest comes 87. Again, 1 to 5 will be paid. In a second year, the leftover amount is 750. On this, 10% interest will be paid. Again, 125. This comes 200. Okay. $500 minus 125, 162.50, 375 minus 125. Interest will be 25 to 125. This will be paid. And in a terminal year, only 125 will be left. Accordingly, 12.50 will be interest and 125. So student, these are related cash flows with the bond. Okay, now we shall compute its present value. Either you can do it in tabular form. I am doing it here in equation form. So you can do both way. Even you can draw one more column along with the present value factor, then it will be also the same. तो जब आप लेफ्ट पेज जाके क्वेश्चन रीड करते हो, ओके, आई जस्ट डू इट. 1 second, I just 1 second. Now I am doing it, computing its present value for the each cash flow, respective cash flow. I am using this here. It is a respective cash flow. I am just discounting the kidney discount the same. You can do at your own. I am just writing here. Please do at your own. Leave some space. Okay, student. Okay, student. So overall value will be, this will be the price of. Okay, student. I'm just coming to the next question. It says the bond is held for a period of 45 days. The current discount yield is 6% per annum. It is expected that the current yield will increase by 200 basis points and current market price will come down by rupees 2.50. Okay, so 200, as I told you in my previous class, 1 basis point is equal to 0.1%. Accordingly, 200 basis point means 2%. Okay, clear? So we have to compute first face value of the bond and bond equivalent yield. Sir, instead of calculating PV separately, can we add? Yes, Manjunath, you can add the column also. Mistakenly, I could not add the column. You can add the column. See, I tell you one thing, it is a very common doubt. Student, presentation can be differ in the examination. It does not always require that you should have a same presentation, mode of presentation. I have done it by way of equation. You can do it by the tabular form because answer will be the same. So don't worry about the same as this. Now, first of all, we compute the face value because face value is missing. This here nothing has been mentioned about the face value. So first of all, we compute the face value that is required. It is the requirement of the question. Okay. First of all, current market price. Now our discount yield is 6%. Okay. We are holding it for 45 days. Okay, student. So it means what we do, we compute, say what is will be the our we discount it by the 45 days. Okay, now let us see how we discount it. Just hold for a second. I am taking here 360. You can also take it by 345, 365 days also. Okay, student. So our discount rate is 6%. Accordingly, I compute the same 6 divided by 100 into 45 divided by 360. So it comes so current market price for 45 days, I think for 45 days, okay, at 6%. So it comes 0.9925. Now current market price for 45 days at 8%. Accordingly, I calculate the same. Now here where my discounting rate is 8%. Okay, so let us solve it. 8 divided by 100 into 45 divided by 360. So it comes 0.01. So here we write it down 990 this. So what is the difference between? It is a kind of a interpolation. 0.225. So in the previous question, we have considered amortized cost and not solved previously question. Yes, Shruti, see beta, please always remember, Shruti is saying very good doubt. It is she's saying, sir, in a previous question, why have you not reconsidered the amortized cost and not solve like previous questions PVIF? Students, please always remember the prerequisite for using the annuity factor is that the cash flow should be the same. Please remember, for using the annuity factor, present value annuity factor, our cash flow should be the same. Whereas in the previous question, since due to amortization effect, the cash flow was not the same, hence we are using different, or we are computing for present using the present factor accordingly for different years. Had the cash flow been the same, then we have used the same. Okay, because why the cash flow was not same? Because of change principle on which we are paying the interest. Okay, now student, we compute difference in price. It is 2.50. So face value of bond, what we do? We divide 250 by 0.0025. The value comes rupees 1000. Okay, student. So accordingly, now it says what is the requirement? We have to compute the face value. So we have reached the first answer. So this is the first answer. Okay. Now next we have to compute bond equivalent return. Okay, student, please. Now, please note. Now it is says we have to compute bond equivalent yield. Bond equivalent yield means sometimes what happens. Actually, this concept is more relevant in context of a money market instrument. What happens in money market instrument? There, the duration of the, as I told you in my last class, the duration of holding period is less than a year. Whereas in bond, the duration is more than a year. So what we do, sometimes we are asked to compare a money market instrument with the equivalent bond. So here we have been come out with the values relating to the 45 days. Now you can say convert this return into equivalent annual return, annual yield. So accordingly, our computation was based on PV 45 days. Now we shall on that basis we shall convert it into equivalent yield. Okay, I'm writing here bond equivalent yield. Okay, student. Now, current market price at 6% yield. Our face value is 10,000. Okay. Our factor was this. We use the factor here. True. Sorry, my mistake. I think our value is here 1000. Make it 1 second. I just write it. Okay. Now correct value is this. So in this case, my bond equivalent yield will be I am investing. I will get 1000 after 45 days. My investment amount is please note here there is no such coupon payment is there because money market instrument are issued at a discounted value. That I will explain you in the next class. At 8% purchase price rupees 1000 into 0.99. Accordingly, my bond equivalent return will be I will get 1000. I am paying right now 990. My investment amount is 990. I want return for the complete year, that is 360 days, and I am holding it for 45 days. See, student, what happens in a money market instrument? There are two conventions. We can say is the actual by 360 or 365 days. So both convention are, can be used unless and until it has been specified. Here I am assuming 360. You can solve it accordingly by 365 days. Okay, student. So alternatively, question can be solved using 365 days. Okay, student. Now I am coming to the last question of this assignment. Now here you will see there are variety type of bonds and instruments. On 31st March 2013, the following information about bonds are available. Zero coupon bond, T-bill, Treasury bill, 10.171 Government of India 2030, 10% Government of India 2018. Here the face value we have been provided. Maturity dates have been provided to us. See, in the Treasury bill, the duration is less than a year because here, as on date, 31st March 2013, and it is redeeming on 20th June. So April, May, and half June. We can say somewhere around half June. Coupon rate not available. Coupon rate and not available because see what happens. T bills are normally issued at a discounted price. Like and for zero coupon bond, as it name says, there is no coupon. So that's why coupon rate and coupon date is not available. No problem. Not applicable. Not applicable. Okay. Now when we talk about 10.71, it is a semi-annual payment. See, it is an annual payment. In this case, there are two payments. One is after each 6 months. So it is a kind of a semi-annual arrangement. If 10 years yield is 7.5%, what is the price of zero coupon bond that would fetch on? Now here, first of all, we compute the value of bond, zero coupon bond. Now student, please remember, for zero coupon bond, there is a very simple formula. There is nothing, any rocket science here. Value of zero coupon bond is, okay, before I write down here, I just explain you and you will get clear. Student, please note, today is 31st March 13. Okay. Now this bond will be redeemed at 31st March 2013 to 23, sorry. Okay. Now there is a period of 10 years in between. Okay. If I draw a straight line, now there is no coupon payment. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, student. Now here what will happen? Yes, Manju, you are right. Your answer is correct, but I am just explaining the student. Okay, student, now see here. Here there will be no payment. Okay, so at the end of 10th year, as I told you, uh, it is always issued at a discounted price. So my maturity amount, face value is 10,000. Accordingly, I will get after 10 years rupees 10,000. So how much amount I should pay today, that will be computed by time value of money concept. Simple. Accordingly, my answer comes rupees 10,000 and my expected yield is 7.5% per annum because the yield is required. Okay, student. So simply we use it. Okay, now we are coming to second instrument. It says what will be the annualized yield or T will credit at this. It can be said that it is kind of a bond equivalent yield. Okay, it is something kind of a bond equivalent yield that we have computed in the last question. Let us see, is there any hint of 365 days? No hint. We can do both way. Sorry, no, it will be number of days will be student. It will be 81 days because it is from 1st April to 20th June. 31 plus 30, sorry, 30 plus 31 plus 20. Okay, student. Don't see present value 4851. Yes. Now next it says uh, what will be the price that will fetch for 10.71 and where having a yield of maturity of 8%. So we should use a discounting rate of 8%. So our coupon payment 10.70%, present value invest factor. Now we come to next point. Here the duration was 10 years because it was maturing on 23rd. Now it is maturing on 28th. Of course, the period will be less. But student, please note one very important point. Here the coupon payment is semi-annual. Accordingly, our coupon will be half, payment of interest will be half, and our accordingly, our yield will also be half. Please note this point. Please note this point. Since it is a semi-annual basis, all thing will be half. This will be also half. This will also be half. कैसे आएगा 98,500 कैसे आएगा बेटा सी Mansha is asking 98,500 कैसे आएगा I think let me show you it is trading at 98,500 it has been mentioned it will be trading at 98 so you are paying a price of 98,500 for 1 lakh T-bill it is given in the question accordingly so this will be the value please student remember one thing it is very important point you will take everything half that's why duration though it was a 5 year but semi-annually. Okay, student. I hope it is clear now to you. Now, with this, we are coming to the end of this uh, first assignment. Now, we are moving to the second assignment. Please read the question carefully. Now, student, please note, I'm just taking back to your slides. When I was discussing with you bond yields, there was a term current yield, YTM, YTL, Y holding period. There is another yield also. One second. There is another yield also that is called Reliance yield to maturity. What happens when we are computing YTM? It is assumed that the throughout the life, the interest amount that is accrued on a bond is reinvested at a same rate at YTM. Okay, in YTM, assumption is that so because even this is was assumption in IRR. However, in practically it may be possible that the reinvestment rate may not be the same as YTN. So accordingly, we compute the realized yield to maturity. Okay, student. Now, for this, let us solve this question because we have to apply different interest rates for the different periods. Equal to future value. Now we compute the future value of benefit. One second, student. Now here we write 0, 1, 2, 3, 4. Okay, now see our investment simply is rupees 900. Okay, now our annual interest is rupees 150. Sorry. Okay. Now compounding factor is at the rate of 16%. Here, student, please note, I need to draw your attention. Reinvestment rate is 16%. Okay, so we shall compound get the value of 16. Now here, student, please, I need your attention. Now see, in this, when we calculate the realized yield, we move in the reverse direction. We move in the reverse direction. How we move in the reverse direction? First of all, whatever be the interest that has been accrued at the end of fourth year will not be reinvested. Okay, so it will be not reinvested. When it will be not reinvested, so compounding factor will be remain 1. Okay, now interest accrued at the end of third year will be reinvested for the 1 year. That is from the end of third year to the end of fourth year. So the compounding factor will be 1.16. Okay, now compounding factor for the 2 year, it means amount accrued at the end of second year means complete 3 year and complete 4 years. Okay, it will be invested for the 2 years. Accordingly, this amount will be compounding factor will become this. We can say like that. Sorry, it's a three. One second. It's a okay, student. It will be 1.35. Similarly, interest accrued at the end of first year will be reinvested for a period of 3 years. True. Now here, we start multiplying the same and we get the value. Okay. Now we compute the overall value. It will be the sum of all these amounts plus this. One second. Okay. Now we compute, we get that their total. So overall, we shall get 1760 during the life. So why are we using compounding factor? Because better, it is a reinvestment rate. It is a reinvestment. The amount is getting reinvested at the rate of 1 second. The amount is getting reinvested at 16%. Okay, that's why we are using the same. Okay, now here, 1 second, 1 second, 1 second. Now students see, accordingly now we shall use our this equation. Okay, future value benefit. Okay, so presently we are investing 900. Okay, we want to compute the realized yield. The duration is 4 years, and overall we are getting the amount of 1750, 1760.50. Okay, we solve the same. Okay, student. So I hope now you have made clear what is the realized yield, no, maturity. Okay, now I am coming to the question number second. Just read the question carefully. It says, based on credit rating of bond, Mr. Z has decided to apply the full discounting rate for valuing the bonds. Credit rating has been given to you. So this is the most secured one. This is then, as I told you, these gradings have been provided to you. Now, student, please note, we have used the term spread, discount rate, 364.5 treasury plus 3%. Spread means this is the difference we add. Now you see, more the risky is the security, higher the spread. Okay, more the risky security, higher is the student. I think there is some typing error. Is make it as a 5%. Okay, this there is a typing error. Make it as a 5% because higher will be sorry, my mistake, my mistake. It was correct. Now you see, one second. 1 second, on the students, 9%. Here it will be right. Okay, I just reading. He is considering to invest a bond face value is selling at this much. The bond has a 5 year of maturity and coupon rate of 15% annually. The next interest payment is due from a 1 year today. The bond is redeemable at assume 65 days, and here it is returned 2%. Now, students, please see. I show you. Here you see. 1 second. Now our discounting rate here is triple A is carrying 364 plus 3% spread. Or alternatively, I can say like that. It can also be presented like that. 364.5 T-bill rate plus 3%. 364 T-bill plus. Now here it is A triple A has been added here. So double A means double A will use more discounting rate. So higher the risk, higher the risk, higher will be the discounting rate. Higher the risk, higher will be the discounting rate. So it will be equivalent to 5. Okay, student. Here it will be plus say 3%. So it will be here 364.5 plus 6 days. So higher is the discount rate, higher will be the higher will be the risk, higher will be the discount rate because this security is risky. This security is risky, even though they are paying equally interest, but it is more risky. Spread means profit. No, Mansha, it cannot be a spread. You are going to, we can say you are talking about the foreign exchange. We are not discussing here. Spread means basically the difference. The generic meaning of spread is meaning is a difference. So it can be a profit or it can be a loss. So we cannot generalize this term, but it is a generalized term is difference. Now, student, let us see. We start discounting it. Okay. The appropriate. Now here it says you are required to calculate the intrinsic value of the bond. Should he invest in the bonds, also calculate the current yield and yield to maturity of the bonds. Okay, student. So my purpose was to let you know about the appropriate discount rate. Okay, so I'm just writing here. Meanwhile, let us just I'm starting the question. Now you will solve at your end during the break. Okay, year one, two. Okay, student, if the approved discounting rate is 14% and is the coupon is the bond has a 5 year of maturity and coupon rate is 5. So accordingly, what I have done, I have discounted the coupon of 15% by this equivalent rate, and my value is coming. So this is justified price. This is the justified price that I should pay now. Now conclusion is drawn. Because he is asking, you are going to calculate, should the Z, Mr. X invest? Yes, Mr. Z should invest in the bond. Okay, he should invest in the bonds because currently it is selling at 1025. Okay, it is currently selling at 1025.86, whereas its intrinsic value is, and so although the difference is not that much, but he should buy the same. So we have taken 9%. Uh, we have taken 9%. No, student, do you want to take 9%? 1 second. No, 9% is C beta. Here, the 364 days treasury bill rate is 9%. Okay, it is the basic rate. So we have at 3% spread. We have at 3% spread. Over that, since we are in category double A, we have added additional this. So that's why we have taken the treasury bill rate. Next it says we have to compute the current yield. As I told you, current yield is annual interest upon price. Okay, our annual interest is 150. Now we have to calculate YTN. Okay, student, before going to the break, I am giving you the hint. You just compute the value at 2%. One is 15% and another is 14%. Then get them interpolated. Okay, 14% value is with you. The value is with you. You need to compute the present value of bond at 15% and then apply the formula of interpolation. So meanwhile, I go for a break. You just solve at your own and I come back. Nisar ji, Nisar ji, Nisar ji. हाँ, अरे निसर को बोलिए वो स्लाइड लगाएगा इसकी ब्रेक की। बोलो। अरे ब्रेक की स्लाइड लगाइए। Welcome back, students. Now, I hope you have solved the question. Let me check. One of two students have tried the same. Now, student, quickly I am writing what will be the value at 15%. Okay, you solve it at your own. One or two students have computed the value. Oh, sorry. 1 second. Now it is clear. Student, sorry, my screen was not visible. I am just doing it again. Now, as I told you, we have to done interpolation. Okay, so we have to done it at 15%. I think one or two students have done the same also. So I'm just quickly writing here what will be the PV of bond at 15%. Okay, student, please calculate at your own. The value will come 99.80. Okay, now 14% value, PV value at 14% is with us. Okay, so we can compute. Now we can compute its interpol by using interpolation. We can compute its the yield to maturity. Now, student, please see here it is available at 1025.86. Accordingly, we shall compute the yield here and PV at low rate. I just write it here. Ten 33.85 minus. Okay. Approximately difference will be 7.95. Okay, student. Yes, one student has got the correct answer. So, student, I hope now the this till this we all questions have been clear to you. Now I am coming to next question, and with this I will make you understand what is the convertible debenture is all about. Now, student, please note when I was discussing earlier in the last class, there was a word like debentures or bonds with embedded option. Embedded option, there is a one category where is a convertible means debentures or bond can be converted into equity share. They can be converted into equity shares, and accordingly we can solve it by assuming that, say, in this case what happens, the debenture holders are given a choice, so they can be both way. It can be compulsorily or it can be optionally convertible. Now if they are compulsory convertible debenture, of course they will be automatically converted into equity share. However, in optional, they are normally gone by that they have a choice. Either they can go for optionally they are convertible. There are no hard and fast rule that you have to get them converted. Okay, so it is as per their choice. They can go for okay, yes, I want to get them converted. Then otherwise, you can continue to hold the same. Now, question comes: why they will get it converted? Of course, they will get it converted because if they will see that there is a prices. Now, what happens if the equity share prices are more? And of course, they will say, I will get it converted. The student, please note that in case of a convertible debenture, there is one very good rule where we say that, see, when we talk about this, I'm taking back to you my slides. Okay, the two points in regard to convertible debenture we have to see. One is state value, another is conversion value. State value means simply the PV of bond that we have sold till net. Okay, we can say it is a price as per the YTM that we have sold till now. Okay, this is called state value. It means even if I hold the debenture till its maturity, how much amount I will get. Okay, this is called YT. This is called state value. On the other hand, conversion value means if as on date, suppose a bond is equal can be converted into 10 equity shares. Okay, now suppose as on date the value of equity share is 2,500. So my conversion value of the same bond will be, because I can get a money of rupees 25,000 by I will get it converted into 10 equity shares and will sell in the market. So of course I will get this value. Now, so basically these two terms are relevant in case of convertible debenture. We have to see because as what happens, we there is a one very good, when we say that we have to compute the value of convertible debenture is equal to maximum of straight value of debenture or conversion value plus option value. It means because we have been given the choice, we have been given the choice. So normally what happens, this option valuation is covered under the derivative valuation topic. Okay, this aspect is normally covered here. When we talk about analysis of a security from the convertible point of view, so we do the basic analysis. Okay, so we normally leave apart this option valuation aspect and we concentrate on the basic valuation. Now, student, as we solve the question, I will explain you the meaning of each and every term. Okay, student. Now let us start solving the assignment. Then you will understand the each and every term. Now please read the question. Now face value of the debenture convertible bonds of Hi-Fi Limited has been given to you. That has been the number of shares that per bond can be converted is 20. One second. Whether I see whether we have seen one query. Okay, student. Now let us see. Number of shares that can be converted is equal to 20 equity shares. Coupon rate is 12%. Market price per share is 120. Market price of convertible debenture is 2650 and straight value of bond is 2350. It means it has been discounted at YTN. Okay, this has already been discounted at YTN. Now we have to convert first, we have to compute the value conversion value of bond. It means it means what from conversion point of view, what is the value of this bond? Simply conversion ratio is our 20. Okay, conversion ratio is our 20. Okay, market price per share is 120. Accordingly, 2400 is our value. Okay, now next it says percentage of downside risk. Okay, student, now please see. Student, please note, a person says, if I buy the bond of this particular company, convertible bond, then what is my risk? What is the maximum risk? What is the maximum risk? Now suppose even if a person buys a debenture, okay, and current price is market price is 120. It may be possible that since equity prices are not fixed, they can be come down, they can be go up. Now suppose even if it comes down to the zero, even if it comes down to the zero, the investor will at least get the trade value of the bond. So accordingly, he measures or she measures how much downside maximum to maximum risk. What is I am carrying? What is the maximum risk I am carrying? So accordingly, it can be like that. One second. Percentage of downside risk. Market value of convertible debenture and state value of debenture. Accordingly, what we do minus state value into 100. So accordingly, today if I am investing 2650, maximum to maximum, if even if the equity becomes a zero, so what I will do, I will take the route of getting it redeemed. Okay, so 2350 into 100. Okay, student. So I hope it is clear to you. Next, we are coming to the computation of, it is saying conversion premium. Conversion premium means if I am taking the route of instead of buying in the market equity share, what I am doing, it may be possible that the demand equity share may not be available in the market. What I am doing, I am taking the route of conversion to acquire the share. Then how much premium I am paying for the same. One second, conversion premium is equal to 1 second. See, I am buying the first. I am buying it from the market. So I am paying a premium price of 2650. And if I take the I get them converted, actually the value of this debenture is basically from equity shareholder point of view is 2400. So it means I am paying a premium of 250. Okay. Or we can say if conversion premium, we have to compute per share. If it has been mentioned per share, then what we shall do? We shall do like that. Because this is the price I have paid to acquire 20 shares, and this is the value. Accordingly, it comes 12.50. Or it can also be computed that way. By paying 2650, I am getting 20 shares. The price per share comes, okay, as on date, the market price is 120. Okay, so the value comes rupees, the premium I have paid for 1. Okay, student, let me check whether I have received any query or okay, student. Now coming to the next part, that is says we have to compute conversion parity price of the stock and also interpret the result. Parity means equality. Parity means equality. Means if I am, we have to see what price. Either I go for a conversion route or I go for the direct acquisition from the market. At what price both we I have a same cost. Accordingly, to get the conversion parity price, bond price divided by conversion ratio. As I have done in my previous section, previous part. So my bond price is, so this much of at this price, we can say like that. How we interpret it? This indicates that if price of share rises up to per share, he or she will be indifferent in buying share from market and exercising conversion option. So it means at this price, he will be indifferent. Okay. Okay, student. Now I'm coming to the next question. One second, student. Now this question is like that. Following data related to 8.5 fully convertible loan if you buy back at the rupees 1000. Market price here this, although the face value is 1000, but it is available at 900. Conversion ratio is 30. Okay, straight value of bond means if we go by the discounting simple, then it will be 725. Market price of equity share on the date of conversion is 25. Because student, please note that it is the market price on the date of conversion matters a lot because it all decide whether you want to go for option. This is you want to exercise your option or not. Now expected dividend per share is this. Now while in a case of debenture or bond, we get the interest payment. Once we get it converted, we get the equity dividend as a investment. You can making the investment. Now we are required to calculate conversion value of bonds, market conversion price, conversion premium, ratio of conversion premium. So all we have calculated for about a premium over state value of debenture, favorable income differential per share, and premium calculated. Now these are three new terms. These are two new terms that I will discuss with you now in this question. One second. Okay, student. Now let us start solving the question. No problem. Conversion premium per share. Okay, market conversion price we have computed here. It is 30. Accordingly, we shall compute the same. Okay, as on date, the market price of equity share. So it means I am paying a premium of 5 per rupee per share. Now next comes the ratio of conversion premium. Simply as the name says, okay, it will come 20. Now next, I am discussing with you premium over straight value. Market price of convertible bonds minus straight value. Okay, so I am here paying the my market price is available at 900 rupees and straight value is 700. Okay, minus, sorry, it will be equal to 28.60. Okay, student. So I hope with this it must be clear to you how we compute the various Now, when we are computing favorable income differential per share. Now, students, when we talk about this term favorable income differential per share, please note that if I am buying a bond, so what I have to, I want, and I get it converted. So what I'm losing, or I say, if I have bought the bond, but I am not getting it converted. So what I am doing, I am waiting. I am waiting to get it converted. However, during this waiting time, I am losing the dividend. I am losing the dividend, but I am getting the interest. But I am getting the interest. Generally, what happens, interest payments are always greater than dividend. Interest payments are always generally greater than dividends. So I am getting some favorable amount. Okay, I am getting some favorable income differential. Now, how we compute this favorable income differential? Let us see. Coupon interest from bond or debenture minus conversion ratio into dividend per share. Now, please note this coupon is in against overall dividend. How much dividend? Because if I am getting more share, more than one share, the dividend will be accordingly increased. Divided by, okay, conversion ratio. Student, so here you see my face value is 1000 and the rate of interest is 8.5. So 8.5% of rupees 1000, it comes 85 rupees. It comes 85 rupees. Accordingly, I am getting interest of 85%, 85 rupees against what I am losing. I am losing, my conversion ratio is 30, okay, and I am losing dividend per share is rupee 1. So I am losing 30 rupees against, if I wait, so I am losing 30, but however I am getting 85. Okay, so this is the overall. This is the overall per share basis. What I am getting more benefit 1.833. Okay, so I am getting income differential of 1.833. So it means I am getting the benefit of holding the dividend. If in the question it has been asked, you are required to determine the how much he will gain per share for waiting to get it converted, then you will use this term. Okay, so it may be possible that in the examination the question may not be directly asked. You should be very much clear about these terms. Only then you will can solve the question. Next term comes premium payback period. I'm just coming to the last term. Premium payback period. Now, student, here we see if I have taken the route of conversion. Okay, so what will I do? I am losing my excess benefit that has computed income differential. Okay, favorable income differential. Suppose if I get it converted. Okay, so it means I am losing something. I am losing something. So how much I am paying? I am paying a premium of 5 rupee per share. Okay, so how much time it will take? Okay, or we can say it is a kind of a break-even time that I have to hold the bond so that my conversion premium becomes neutralized. My conversion premium become neutralized. Otherwise, I have to pay more and more about. So conversion premium per share divided by true. So my conversion premium is rupees 5 as I have converted above. Okay. Now here my favorable income differential 1.83. So it means if I hold the bond at least for 2.73 year, only then I will be indifferent between the getting it converted or continue to hold the same. Okay, student. So this is a premium payback period in which per time my premium will be come back to me or I will be on the recover the extra amount I have paid to get it as a share. Okay, because see what happens. I am paying for a convertible debenture. More amount I am paying. So if I am paying a premium instead of I take the route of directly market, but I am paying a premium to take the convertible debenture. So in how much time I can get it recovered back because I will get a one some favor from the interest. I will get some extra payment from the interest. So by this I will get my premium will be get offsetted by my holding the debenture and for how much period I have to hold this time. This is completed by premium payback. Okay, student. Now I am coming to the next question. Okay, the question says like that. Face value bond of 1000, coupon interest is 8.5%, time to maturity remaining 3 years. Interest payment at the end of year, it means it is the annual base payment. The principal payment at the bond maturity. The conversion ratio 25. Current market price per share is 45 and market price of convertible bond is 1175. So it means face value, we are somewhat paying the premium of rupees 1175 over and above the face value. Okay. Now A category bond can be issued the plain vanilla bonds without conversion option at the interest of 9.5%. So it means it is the YTM. Is the YTM. Now here please note in the earlier two questions we are provided with the trade value. Okay. Now here We are not provided with the straight value, rather we have to calculate the same. Okay, now let us start solving the same. Now straight value means first PV factor has been given to us, so we shall use the same. Okay, so I just write it how. Okay, student, the value will become 974.96. Please compute at your own also. We add up the same, we multiply the same, we multiply this value with the same, the value resultant value will be the this much. Or I can write here 0.9132 plus 8340. Please please note that student. Here, since PV factor has been given up to 4 decimal point, so I have to take here to 4 decimal point. Please note that. I cannot do it rounding off because it has been provided in the table itself. It is a clear cut indication that I have to take up to 4 decimal point. Accordingly, no problem. Conversion premium. Okay, this much I have paid the amount divided by my ratio is 25. The market price as on date is 45. It has asked for conversion premium. One second. So I can do that way also, per share also, or I can do both way. 1 second. 1 second. I can do like that. I can do is a per share basis also. So per share it is coming rupees 2. Or what can I do also? 1175 minus 45 into 25. Okay. So my value comes 1175. So it will be 100, 4.44%. Okay, that way we can also compute the same. Then it comes the percentage of downside risk. Here we have computed the straight value. So even if I buy at this value, I will get always. Not always, as on date, I will get at least this much of values because today is YTM. So what I am paying extra premium, I am paying this much of premium. Okay. Next is conversion parity price. Okay. So it means at 47, I will be indifferent whether I buy it from the market or I get the conversion route. Because right now my market price of the share is 45. So if it rises up to 47, then I will be indifferent. Okay, student. With this, we come to an end of the one of the concept of the convertible debenture. Next, we are coming to the uh, concept of bond duration. Okay, let us discuss the concept of bond duration. Student, while we were discussing the topic of equity valuation, there was a concept called beta. Beta indicates the sensitivity of a particular security vis-a-vis to the market. Now, sometimes it is said that because equity are driven by the various factors like macroeconomic factors, companies, own valuation, etc., etc. Now, question comes whether the fixed income securities like bond, etc., are affected or are their return is volatile. The answer is yes. How their return is volatile? Because we have observed that there is an inverse relationship. There is an inverse relationship between the value of a bond and YTM. Okay, if YTM is increasing, the value of bond will come down, and if YTM is going down, the value of bond goes up. So I'm just showing it again here. Okay, so it was the yield and it was the price of bond because they hold a inverse relationship. So we have seen in earlier question also, with the increase in yield, the price is going down and accordingly. So this was again. Now question comes, how much this value goes down or goes up is called volatility. It is called volatility. Now how we calculate this volatility? We calculate it by the duration of bond. From duration of bond, we compute modified duration of to calculate the volatility. It let us know how much the value of a bond will change once there is a where there is a some particular change in the YTM. Now, what is duration of bond means? Basically, generically or generally, duration of a bond can be explained as it is a, or it can be said that it is a time period within which the principal amount is returned back to the investor. Time period within which the principal amount of the bond or debenture is returned back to the investor. So duration of bond is returned back to the okay. Higher will be the coupon rate, lower will be the duration. Okay. So according to what happens, normally the duration of bond shall be duration of a coupon bond. We can say duration of a coupon bond will be less than its maturity period. Okay. However, in case of zero coupon bond, the duration of bond is always not that will be equal to its maturity period because there is no intermittent interest payment. Whereas in case of coupon bond, there is somewhere in intermediate payment. That's why its value gets returned. Now question comes, this bond duration term was start using by Macaulay. One second, Macaulay spelling. I think its spelling is Macaulay in 1938. So accordingly, somewhere you can see Macaulay duration. It is also called Macaulay duration. So one and both are same thing. Now let us see One second. What is the equation? Approach to compute the duration. Okay. Duration is equal to, first we shall compute the Macaulay duration, then we shall compute their modified duration. T vary from 1 to n. Okay, upon P. What we mean by CT? It is cash flow from the bond. Okay, P means it has been, one second, I think it has been erased. No problem, I'm just doing it again. Okay, CD cash flows from the bond, T is time, and P is present value of bond or straight value. Okay, student, please note this can be in a tabular form. This is a version is basically nothing, but it is a kind of a tabular form. Once we solve the question, then you will understand. It can be converted into a tabular form. There we can compute the very easily. Now next comes, student, if you see your study material, there is another approach has been given to you for to calculate it is a kind of a formula approach. Okay, Shreya is asking, sir, whether we can use this formula or start. No, I'm just coming to it. Just hold on for some time. Now here we can use this approach also. One second. Okay, this approach has been used in the book. So student, please note that either you can use this approach or the approach I have discussed. But there is another approach also that I will discuss while I will be solving the question. Both approach can be used, so don't worry about the same. Okay, now where Y is mean, C means open, okay, student. So you can use any of this approach. There will be not a problem. Okay. Now some of the properties I am discussing with you. Okay. First property I have discussed, zero coupon bond duration is equal to the maturity. Okay. Second property is maturity period. Okay, coupon bond. Then third, inverse relationship. Very important. Okay, inverse relationship between coupon and duration. Between coupon and duration. Okay, because as the coupon rate are increasing, the duration will be lesser and lesser because of high recovery. Between terms to maturity and duration. It means longer the maturity period, higher will be the duration of the bond. That is, more time will be taken to recover the invested amount. So this is a kind of a relationship. Okay, student. Now, when we have to calculate, then we discuss the modified duration. It is also called sensitivity or volatility. Okay, it is computed as follows. Modified duration is equal to, okay, it is computed as this. Okay, it means D means duration and Y means YTM. Accordingly, the change in the price of the bond will be negative modified duration into change in the YTM into price of a bond. Okay, change in if because if modified duration is 2, okay, and change in YTM is 1%, and price is say 500. So the change in the price of the bond will be, if it is increase, please not if it is increasing. So the price will be 500 into 1%, 1 second, into 2%. It means there, if the price yield is increasing by 1%, then there will be a fall in the price of by 10%. Similarly, now if suppose I am here casing the case of my increase in yield by 1%. If I am considering the case decrease in yield by 2%, so -2% into 500. So it means 20 rupees will be increased. Now my earlier my price I was coming 490. Here my new price will be 520, because with the fall in the yield, my price will be increased. So student, with this, I am coming to the end for the today's lecture. In the next class, if we shall solve the questions on the duration of the bond, and if time will permit, I will come to also solve the questions on the money market instrument, or and this is also whatever the topic we have left. So if in case time would not be suffice, I will take one extra class for this money market instruments and remaining topics of the bond valuation. Because in bond valuation, there is one topic left, bond refunding decision. See, first of all, I will start my lecture with this bond duration, then I will come to forward rate, that is yield curve, etc. Then I will coming to money market instruments, and then bond refunding decision. So these three topics I will cover. If time will not permit, I will take a separate class for the same. So don't worry about every topic. Each and every topic will be covered in required classes. Okay, student. With this, we are coming to the end of the session. Now, as a customary, if you have any, you can send us any query at your mobile app. Now, student, there are some mobile apps. I have seen many queries there. However, due to some other engagements, I will reply them by Tuesday. Almost I will reply each and every query, because there are some other works are going on our board of studies. Meanwhile, you can contact us over the telephone at this number. I will be there, okay, or my assistant will be there. So please be in touch and start, keep on learning. And whatever the question we have solved in our assignment, there are some variety of other questions are also given in your study material. So my request to you, please solve at the question and try to solve this question at your own. And if you face any problem, please do contact us. Okay, student. Thanks a lot for patience listening, and have a nice day. Thank you.